In tax, there are some kind of transactions that can result in you not having to recognize any gain or loss, depending on what they are. One of the examples we're going to look at in Learning Objective 6 is like-kind exchanges. We're not going to address any of the other ones that the chapter talks about, just like-kind exchanges. So when you've got one asset and you exchange it in a transaction for another asset. The government basically takes the position here that you're not really, you're just trying to maintain the economics of your situation. You're trying to get a replacement asset for one that you had used for whatever business purpose. And so they don't want to tax you or cause a tax event to occur when you need to exchange assets. So they allow you to defer any gains or losses when this type of situation arises. So I think I just want you to kind of read through what like-kind exchanges are. This is just some forms and filing, how that would look. Like-kind property is defined right here. It talks about real and personal property, ineligible property, how the property has to be used. There's some timing issues. And then this kind of gets into the important sort of the mechanical parts of this. What are the tax consequences when like-kind property is exchanged solely for like-kind property? So read through this. You kind of just exchange basis. So whatever your basis was in the old property, that becomes your basis in the new property. And there's no gain or loss required. Sometimes, though, if there's more to the deal than just two pieces of like assets, then you may have to recognize some gain. So if you exchange property, like-kind property and also non-like-kind property is involved, we call that boot, then you might have to recognize some gain. So if you're party to a transaction where you're exchanging a piece of property and you're getting another piece of property and boot, you might have to record some gain to the extent you're getting this boot or this non-like-kind property. So read through this discussion and then see how the recognition would work when boot is received. It's a good example for that right here in 10-15. And then there is basis in like-kind property. So what's the basis in the new piece of property you're getting? A good rule of thumb calculation you can use is this: fair market value of whatever your property you're receiving minus any deferred gain plus any deferred loss. So in these situations, you would always calculate your gain or loss first, okay, and then you would see what any deferred amount would be. If you've just got one piece of like-kind property exchanged for another, then every bit of the gain or loss is going to be deferred, okay, so you won't have any gain or loss recognized. Then you can look at figuring out what's the basis in the new piece of property. In that example, the basis in the old piece of property will be the same as the basis in the new piece of property. But you could also look at it like this, and you get the same answer by taking the fair market value of the new piece of property plus or minus any deferred gain or loss, depending on what your situation is. This can be a little bit confusing. If you've got questions or you don't understand the homework problem about this, then you can send me an email and we can converse about your specific situation.